Where is the 50 pips? Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. End of the week. We've had some fantastic moves this week. Today we're going to be talking about where is the 50 pip box. So I've received a ton of emails, some traders, a lot of traders with some great results, and some other traders some mixed results, and some other traders still getting the concept but still struggling with the live time execution and getting that result. Don't get frustrated. Use that frustration to keep making little incremental improvements. Like Richard Dennis said, when you're trading small, or when you're learning to trade, or when you're trying to improve your trading, that's the time to make the most mistakes. Don't be trying to make mistakes when you're trading big, or trading with more leverage or more size, or doing the things possibly that you're not ready to do yet, and just focus on constant progress. Where do you want to be next week? Where do you want to be in 30 days, 90 days, or this time next year? I can attest to 20 plus years of studying the markets. If I had just had some of the basic understandings that I have now, and had the patience 20 years ago, even 10 years ago, the difference that it would make in my trading now. So step back, be patient. Today, hopefully this will tie some things together. Yesterday we talked about high bull, low bear, profitable trades, the things that I try to bring to the market each day to filter out uncertainty in my process. And again, just peeling back the onion day after day, getting in just deeper layers for that simple, duplicatable, scalable system, and just then mastering your execution. That's what it boils down to, is being able to execute in live time and just repeating that consistently over and over again, bumping up size to where that all becomes normal. Whatever size you're trading now, if you're doing that on a regular basis in terms of getting the results consistently, it doesn't matter how big or how little you're trading. Size is irrelevant when you're mastering the process. So at some point in the future, you might be trading 10 times bigger than you are now, but it'll be the same execution over and over again. And that's what we're talking about today. Coming to the market with our process, our simple system. We're looking for structure. Do we have a geometrical pattern that's built up over a day, 2 days, a session, whatever that may be, for a sell setup, a buy setup, to give us our bias or our thesis for structure, for measured moves. We talk about the high of the day, the low of the day. We're going to go into that a bit more today in terms of how we can start to just again focus on numbers and where the money is, because the market is going to come out. Every time they move the market, effectively they're moving it to stop out profitable trades, whether that's from high to low, or extending the range down into an existing trend, or to trap traders chasing a move further down lower or further up higher, getting them in late, chasing the momentum, the pushes. Traders, these guys are good. They're the best in the business. They have so many tricks up their sleeves. We're up against the most competitive, probably best educated, best equipped, best access to information. They're the ultimate opponent. It's like playing chess against the computer. It has every move programmed into it, but they can't hide their footprint. And so we know that the majority of highs and lows are where stops are placed. And we talked yesterday about the high bull and the low bear. Those are trades that are in profit, so the profitable trades. So it may not be the previous day's high, it may not be the previous day's low, but it may be the most recent high or recent low from the previous session, whether that's Asia, London, or New York from the previous day. If there's an existing profitable trade, we can start to identify where our 50 pip boxes are. So we go into consolidation after yesterday. So our day ends, we go into the next day, we go into consolidation. The market may take out the previous day's high or low. I've talked about that as one of my triggers for looking for other time frame traders, bigger money to be entering the market to possibly drive a move, or now to be interested in positioning themselves maybe on a false break reversal, or for a trend trade if the market's making new highs or making new lows in a trend. So when we go into consolidation, we'll have a high and a low where there's been a low bear and a high bull. The low bear or the high bull may be in today's session. So we may come out of consolidation. The trend could be down, and the market could possibly, you know, it's made a low, it's made a high, and we go into the Europe-London session, and all of a sudden we see that pumping happen and start driving the price. Traders have a bias that the trend is down, and they get an engulfment or a big candle. We saw this yesterday. We're going to go over some charts from yesterday as well. They get in short. They might even try to get in at numbers, and they get in short, and then all of a sudden the market reverses. Next thing you know, they're going up, and they go up. It might even be almost 50 pips from top to bottom of the move. They get up to the next number level. Now, two things before we go to the screen. We might have looked at 0 and 50, for example, as a 50 pip box, but we don't know if they're going to go down. We don't know if they're going to go up. We talk about this. It's about how price behaves when it gets to a certain level. Now, this market may have broken out and gone after the money down here. They may have made a new low. But we want to be I always look at the numbers, because the numbers, when we're here, we're in the middle. We're in the middle of yesterday. Unless we've taken out a previous day's high or low, we're inside of a box. I talk about the numbers. We could say there's our 50 pip box, 0 and 50. But if we go long here, we're getting filled somewhere between 25 and 50. So then we're going to be thinking, well, I hope this goes to 75. But if we start looking at where the money is, it doesn't matter where they go. They're giving us now an expanded range. So they're expanding today's range. So we go from consolidation, and they break out, which is possibly a stop hunt or a false break. We don't know. But when they move, now they're expanding today's range. So as that range expands, we could go from 25 or 50 pips to 75, or we might go 50 pips and they might come back down to the bottom. We talk about timings, the 12 candle window. So what's important is the 12 candle window. We know that we're possibly going to have a stop hunt, trap, trade. Now, sometimes a lot of traders want to be in this first move, whether it's down or up, at the beginning of the session. There may be a trade there. They may be positioned in the stop hunt. The stop hunt could be 50 pips. But what's important is that as that range starts to expand, we talked about they may not even go to the high. So a couple of questions have been asked. I'm waiting for it to get to the high, and then it doesn't get there, and I miss the trade. Or to the low, and then I miss the trade. This is where behavior, price action, and timings all come together, because they may go up here, and the stop hunt may be just to get the trader at break even who's in profit, because they're selling maybe off of 50. So we talked about high bull. They might go sideways and engulf it. They might give a pin hammer on a 1, 2, 3 for a breakout pullback that fails, and then go back and hit it one more time. But it's important to just step back, not get caught into the breakout. Sometimes is just the expansion of the range. It's again, start looking at the numbers. If it fails at 50, so we want to be looking at the numbers. The candles are going to distract you and get you chasing price. If you can step back and look and say, okay, I think that this is my 50 pip box, but all of a sudden they break out to the high, well, now we might be looking at 0 and 50. If they keep going into that 3-hour high and low, before they go into consolidation, it might be 25 and 75. If it's a trend trade, guess what they're going to do? At some point, there's going to be a 1, 2, 3 back into the trend, or 3 pushes into the trend. in that 3-hour gap maybe. It could be, they could extend the market out in that first 3 hours, go into consolidation, come down 25, hit the high again in that second 3 hours, and all of a sudden it's a sell high setup at the beginning of the US session. We've moved it from 50 from the breakout to the high, but in the US session now we've got 75 from high to low. So just step back and be patient. Think about timings. Remember the 3-hour window. They set a high and a low. If they extend it out in that second 3 hours, or if a trade that a trade that evolves in that first 3 hours doesn't go anywhere, start paying attention to that gap time, because you're going to get the stop hunt, there's going to be a trap, and there's going to be a trade. Now sometimes that trade may only go 25 to 50 pips. We don't know that. But when they go back to the high or to the low, or when they stop hunt back into the trend and give an engulfment or a pin hammer, that trade now has a measured range potential after the expansion of the range has happened for more than 50 pips. But remember, who's in the money? Because when that money's there, they are going to go and stop those traders out, whether it's at break even or with a loss. So just to reinforce the high and the low, okay? High bull, low bear, profitable trades from the most recent session. If the market breaks out of one of those and triggers a new daily low or a new daily high, now we've got a market that's in action, it's in play. And that trend, if it breaks a new low, well, we're making new daily lows. So then we're thinking stop hunt high for a sell. So they may drag the market down, hit the high, drop it down, and it may only go 25. But then they come back in New York and hit the high again for a sell to continue the downtrend. Or they hit the high, they hit the low, consolidate, reverse the market, take out the high. But just step back and start looking. I look at the numbers. I'm constantly focused on high bull, low bear numbers, because I need at least 50 pips. When the market goes into consolidation, I want to know there's a 50 pip move. If it goes 25 and goes sideways, that may be a middle structure for a bigger pattern later. So you get into a trade, it only goes 25, 30 pips, whatever, and all of a sudden comes back and stops you out, and you're like, this doesn't work. But what's happened now is we've got a high and a low structure, and we may have a high and a low for the day that are 50 pips or more apart, and that middle structure is what gives us our geometry now for a measured move. So where are the profitable trades? Where's the high and the low, bull and bear? What are the numbers? Step back. Don't get caught into chasing all the candles whipping back and forth. Look at the highs and lows. Where are the stops? Where's my 50 pip box? I'm constantly looking at the numbers, and we talked about this. The trades will usually be from 50s and zeros and 50s. So if you're at a quarter level, that may be the stop hunt if it's at the high or the low for the session or for the day. And then the timings. Every day, we've seen this day after day after day after day. Show me one day where there hasn't been a textbook 50 pip trade at the timings in the 12 candle window. So keep it simple, and then just focus on price action. How does price behave when it gets there? Engulfment, pin, hammer. If you can't see the high or the low, or you're at the high or the low for that day, and we're at the weekly high or weekly low, well, that's even better, especially if the market gives us that in the gap time prior to the next session. So if we get a 50 pip or so move, we're at the high of the week, the low of the week, and the market goes into consolidation just prior to the US session, and we have 4 candles and there's an engulfment and a pin hammer, we've now potentially locked in the high or the low for the day. So hopefully that helps. Where is my 50 pip box? I'm looking for the 50 pip numbers where the stops are, not chasing the moves. When they break out, they're expanding the range. That may be a 50 pip move, but they're going to come back and get the guy who got it right out of the gate. Stay disciplined, traders. We'll look at some examples from yesterday's trades. Keep it simple. Step back. Don't try to chase all the moves. Let them set the market up to trap volume before they shift it fast for 50 pips. Have a great weekend. Keep today simple, end the week on a strong note, and may the markets go with you.
Good day, traders. Stacey, Burke, continuing our discussion on our identifying our 50 pip box. So again, we come to the market each day and we want to spot profitable trades. We talked about this yesterday. We talked about existing trades as we head into our consolidation in Asia. We want to identify profitable trades that are in existence because we know the market will come back to get those trades. And we talked about low bear, high bull, and again, just some simple concepts that will potentially help us spot where the market is going or where the money is. Because once they've done their business and they've cleared the board, they may be done doing business there and they're going to go to the other side. So we mark off our levels. And we're looking at the British pound USD from yesterday. Just as an example, we come into our Europe 12 candle window and we get a 1, 2, 3 engulfment. Stop hunting traders who have taken the breakout of the bear candle just prior to the Europe window, obviously thinking possibly that's going to go through to the high of the day. That market then reverses and goes 1, 2, 3 engulfment. Takes traders short, then they get traders going long before London opens, hitting the low again one more time without taking out the extreme. So traders may have had their stops below the low of the day before it reverses on a big bull candle. And again, an example, we've got the breakout candle over 25 pips, and it forces traders to be buying high up near the high of the day in terms of the range, even though we may have potentially spotted a box. Now again, talking about numbers, a 50 pip box, the market is forcing people to buy high near the high of the day. So we like to see these setups occur down low or up high. Now, just to come back to what we're talking about, and that's identifying a 50 pip box. If this is our high bull, high bull, and the high of the day is at round numbers at 24.50, we would want to be, if our thesis is that we're going to be getting a stop hunt to the high, we want to be thinking, what's the high minus 50 pips? That's what I do. I go, what's the high minus 50 pips? The high minus 50 pips is double zeros. But the market goes sideways at yesterday's low. So now we're potentially, we talk about asymmetrical risk reward. This is my approach to identifying asymmetrical risk reward. If this is a stop hunt and I want 50 pips and I'm buying this breakout candle and the high is at 50 and my fill's at 32 or 33, I'm risking, and this candle is 25 pips. I'm risking 25 for 15 pips basically. Now you could say, well, I think that the market's going to do a measured move of this little geometrical pattern. So let's measure that from high to low. And the market did do a measured move of that geometrical pattern, two times this smaller rectangle off the low. So if our target then, before the candle closes, you've done your math, your target is roughly 60 less the spread, and we get filled at 32, we're looking at a 28 pip move and we're risking 25 pips. Again, you may take that trade, but you would definitely need to be at break even when the high is broken, but we can't because we get stopped out right away because we're too close to the high. So then we wait till the next high gets taken out and we go to break even. The market comes back and goes sideways and we get stopped out at break even. Okay, that's here nor there. We don't know what the market's going to do. But when we look at the numbers, again, our high and our low are less than 50 pips apart. But as the range expands, now we have a high that's up at 64, and we have a low of the day that's down at 03. So now we have a 50 pip box in terms of not only the high and low, but also numbers. So if this market is going to give us some sort of setup. We need it to be either buying below or at double zeros or selling at or above 50. The market goes up 1, 2, 3 reversal in that gap time, drops down, pulls back in the US session, and here we are again. Your risk reward is less than 50 pips. So unless you're getting in on a smaller time frame and your thesis is that we're going back to the low of the day, you'd be wanting to get filled at numbers. This is why I focus so heavily on numbers. Traders may have shorted this on the 1-2. The problem is that unless you're on a smaller time frame, you're jumping in front of momentum. And when we get the reversal candle, again, we talk about limit orders and whatnot. This is an example of where they give you a fill price away from the numbers. The consolidation is inside of the box. It's not at the numbers. So again, they're making traders chase price inside, and the risk reward is less than 50 pips. Now, obviously, if traders shorted it at the numbers and targeted the 50, they got their 50 pips. But again, just using the 15-minute chart, this trade setup itself was not ideal for me to be taking for a 50 pip move. But again, just coming to the screen and looking at high and low, high bull, low bear, where's my 50 pip box? So the market goes up, goes into consolidation. We're looking for a sell high at 50. We didn't get it on this pair. If we looked at the pound yen, just get rid of this. Again, we mark off our levels, most recent profitable trades. And as the day progresses, we have our high bull and our low bear. So we've got traders who have entered the market possibly off the engulfment at the low bear of the day. They've bought the bull candle reversal at the second candle of London. The high of the day is up at round numbers at 50. Traders may have entered in on a smaller time frame on a fill near or at the numbers for a 50 pip move up. But as we head into the next session, we have our 50 pip high and low. The range expands outside of 50 pips. We get our 1, 2, 3 reversal in the gap time. But instead of dropping down inside of the box, the market then goes back 1, 2, 3 numbers and reversal candle. Sideways engulfment, bull candle. Traders short that, expecting the move down through the low. It goes into consolidation at the round numbers. So again, we expected that we had a high and a low that was more than 50 pips. Again, fighting for best fill price. We had our trade confirmed in the gap time with the tweezers reversal. The market then stop hunted back up to the numbers. Traders had the opportunity to get filled at the numbers or on the reversal candle. The market failed to follow through. So you take what the market gives you, and that's it. It's not something to get frustrated or angry about. It's mastering your perception of where your 50 pip box is. So coming back to our numbers, the market dropped down 75 pips, went into consolidation, breakout pullback, consolidation, working into the numbers, stop hunt down into the numbers, breakout pullback, reversal for the move back to the high of the day. They've cleared out the high of the day, pulled it back inside, hit traders again at the top who shorted this market, pulled it back and hit it a third time. So 1 push, 2 push, 3 pushes, reversal. Traders sell it off. It drops down to the round numbers. And again, I talked about this in my trading plan outline. I'm expecting a 50 pip move. The market goes sideways at round numbers. Double zeros can act as a potential level for a trade to fail. So we take what the market gives us, and that's it. So we look at, now again, not to say that you'd be trying to trade every setup, but we're just giving the scenario. We're looking at the numbers. Where's my 50 pip box? Okay, 0 and 50, 0 and 50. Pound Swiss. Mark off our profitable trades. They're going for the money. They're going to go back and make a stop hunt. If they don't, they're going to take out a daily high or daily low. It's that simple. So that's why when you get 75 pip of movement from high to low, chances are they have an extended range, and now we potentially have a market that's going to reverse. So our profitable trade from this session would have started right here at the open of the 12 candle window in Asia. We had an engulfment, bull candle engulfment on the bear doji. The market goes sideways, gives us a rectangular structure. Stop hunts, breaks out, measured move, comes back, hits the high again, but we get our tweezers reversal in the gap time. 1, 2, 3 reversal. Goes sideways at numbers, traders shorted at double zeros, and the market drops down to the low of the day. Great example again of where the market didn't go 50, it failed at the low of the day. It goes sideways, we exit the trade, we take what the market gives us. Now traders, again, the reason why we follow the 6 pairs is that we're looking for the best trade setups. We're not trying to trade every single pair. So just giving you some scenarios of how I would have, when I look at the screen, when I go to the chart each day, we mark off our profitable trades. And again, we're looking for the pairs that give us the best textbook setups. And when we look at risk reward, this is what we're looking for. Where are the numbers? Where are the stops? Where are the profitable trades? So, great example on the pound New Zealand. The market drops down in Asia. We get an engulfment, extends the range another 25, going into the Europe-London 12 candle window. We get a 1, 2, 3 into the London Open to round numbers to 50. They drop it down, pull it back, drop it down again. Traders might have shorted this. They're in the market. But again, 25 pips, and they go sideways, and they also hit the low of the day. Okay, so let's say we're out of our 12 candle window. The market does a 1, 2, 3 to the high of the day. So coming back to numbers, when the market starts the day, we're inside of 50 and double zeros. We have a 50 pip box already in place right here. We're in a 50 pip box. But the market breaks out of the 50 pip box, 25 more, pulls it back. But you notice they've even though the market's extended that move, they're inside of this 25 pip box. They break out, they pull back, and they do 1, 2, 3, breaks into the upper box, fails, goes sideways, works the low again. It's in a 25 pip box. This is what I was talking about by not letting the candles fool you. You're inside of a 25 pip box here, and you're near the low of the day. They're working the low, working the low. What do we need to do? What do we need at the low or the high to go long or to go short? Pin hammer. Okay, engulfment. If you chase the engulfment, look where your fill price is. You're right in the middle of the box. Your stop is outside up here or right here. And what did they do? Bang, bang, they hit the stops. So whenever you get filled inside, in the middle, be very aware that if you're chasing a fill price and you're caught inside, this is why your risk increases, and you're less likely to be in the right, where you're either early, which means you sit through heat, or you're caught chasing the move and you're trapped. But you notice when they went and reversed the market, they went into consolidation, pin hammer, hits the stops, sideways engulfment for the move to the high of the day. What do they do at the high of the day? The high bull gets engulfed just prior to our 12 candle window. The bear pin hammer confirms that. The bull candle is a 1 bar stop if traders short the bull candle, our first candle of the 12 candle window, but the trade was already in play. Numbers, we have more than 50 pips to the low of the day. Now, again, we don't know what the market's going to do. We enter into the market. We fight for best price at or near the numbers. The market follows through for our 50 pip trade. Again, just looking at risk reward, I'm always looking at the numbers. We have 75 pips on this pair where the other pairs had 50. This market made the 50 pip move. But just going over, reinforcing the basics. Where are the profitable trades? Where is the money? Where's the high bull and the low bear? Where did the last trade move from? Where's a profitable trade? Did I get a valid trade signal, or did they make me chase the trade? Like, you get an engulfment like that, you need to be very, very suspicious. We should be getting filled at or near the numbers. The market hits the high, goes sideways, where? At round numbers, after it did the stop hunt. Some traders shorted this yesterday at the double zeros. Comes down, they're already up, they're at break even before the US session even opens. Then the market drops 75 pips from top to bottom. Goes into consolidation. We have a stop hunt this morning. Okay, we have a new daily low in place. We have an existing profitable trade at the open of the Asian session. And now we wait. We wait for a low of the day that could possibly be put in place. And then we wait for our box to expand. We're almost at a 75 pip box now, but we have a new daily low in place. We have other time frame traders in the market. Now we wait to watch how this unfolds as we head into the Europe-London Open. So hopefully you got some value out of today's video, traders. Where are the profitable trades? High bull, low bear. What are the numbers? Where are the numbers? Where is my 50 pip box? Because I want to know when they hit the high or they hit the low, that there's a profitable trade at least 50 or more pips away, that if this market sets up and gives me a valid entry signal, that I can position myself with a 1-bar stop with a 2 or 3 or 4 times my risk reward on the trade. And when these move, as you can see, they move fast. When they do a stop hunt, it moves fast. So have a great weekend, traders. Stay disciplined, stay focused, end the week on a strong note. 1% better every day. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets. And this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.